Bismillahirrahmanirrahim. Today we will discuss about generally accepted accounting principles. Shortly we say GAAP. Before we will discuss what are these generally accepted accounting principles, let's discuss their need first. As the accounting information is important and stakeholders rely on it extensively, so the financial statements must be prepared in accordance with some standards. GAAP are these standards. The reliability of financial statement is possible when they are prepared in compliance with generally accepted accounting principles. If these principles are not followed, then it is difficult to make comparison of different organizations working in a same industry or the performance of single organization in different periods. Also, it is not reliable and its acceptance is questionable. Let's define GAAP. GAAP provides the general framework for determining what information is included in financial statements and how this information is to be presented. By using these principles, accountant can prepare financial statements and reports. As these principles are not natural laws, then the question arises, who developed GAAP? There are two independent bodies involved in this: Financial Accounting Standard Board, shortly we say FOSB, and Security and Exchange Commission. FOSB is an independent rule-making body who established accounting standards, while Security and Exchange Commission is a government agency responsible for the enforcement of GAAP. We can classify GAAP into three main groups: accounting assumptions, basic accounting principles, and accounting conventions or modifying accounting principles. Accounting assumptions are like pillars of accounting structure. They provide foundation for the accounting process. These assumptions include accounting entity assumption, monetary unit assumption, going concern assumption, and accounting period assumption. We will discuss these assumptions one by one in preceding lecture. Second category of GAAP is basic accounting principles. These principles provide guidelines that how transactions should be recorded and reported in financial statements. These include cost principle, revenue principle, matching principle, disclosure principle, dual aspect, and objectivity principle. Third and the final group of generally accepted accounting principle is accounting conventions. Accounting conventions address specific issues that accountant encounters when preparing financial statements. Accounting conventions are intended to resolve issues with specific transactions that are not properly handled by accounting standards. Many businesses benefit from these conventions when it comes to reporting financial data. These conventions provide scope that certain assumptions and principles must be modified in order to prepare accurate financial statements. These conventions include consistency, materiality, conservatism, cost and benefit, and substance over form. We will discuss all of these in another lecture. This is it for today. You can practice MCQs of this topic in the next slide. Thank you and please subscribe for further such videos.